10 terms every investor should know. If you're new to investing, you may encounter some unfamiliar jargon. Understanding the following terms may help you become a more confident investor. Portfolio. An investment portfolio is a collection of investments owned by an individual or an institution. Typically, a portfolio comprises of a mix of asset classes such as stocks, bonds, and cash. An investor risk tolerance, time horizon, and investment goals generally determine the portfolio asset allocation. Stock. Stock is a security that represents ownership or equity in a corporation. An investor who purchases shares of a stock owns a piece of the company and has a claim on a portion of the assets and earnings. Shareholders are subject to the potential benefits and risks of that position, which means they can make money if the company does well or lose money if the company does poorly. The return of principal value of stocks fluctuates with changes in market conditions. Shares, when sold, may be worth more or less than their original cost. Bond. A bond is a fixed income security issued by a government entity or corporation to raise money needed for ongoing operations or to finance a new project. Investors who buy bonds are essentially lending money to the issuing organization and become a creditor. A bond holder typically receives interest payments at regular, predetermined intervals. These payments are based on fixed annual interest rate and also known as bond coupon rate. Bondholders can expect to be paid the full bond's face value amount at the stated maturity date, barring default by the issuer. The principal value of bonds may fluctuate with market conditions, of course. Bonds redeemed prior to maturity may be worth more or less than their original cost. Cash. Cash is another investment type or asset class. It includes currency and cash alternatives that offer low risk and high liquidity. Some examples of common cash alternatives are savings accounts, certificates of deposit, which is commonly known as CDs, and U.S. Treasury bills. By the way, the FDIC insures CDs and bank savings accounts, which generally provide a fixed rate of return up to $250,000 per depositor per insured institution. U.S. Treasury securities are backed by the full faith and credit of the U.S. government as to the timely payment of principal and interest. Mutual fund. A mutual fund is a collection of stocks, bonds, and or other securities purchased and managed by an investment company with funds from a group of investors. Shares are typically bought from and sold back to the investment company at the end of the trading day, with the price determined by the net asset value, also known as NAV, of the underlying securities. Mutual funds offer investors the advantages of diversification and professional management. Diversification is a method used to help manage investment risk. It does not guarantee a profit or protect against investment loss. Let's talk about exchange-traded funds. An exchange-traded fund, also known as an ETF, is a portfolio of securities assembled by an investment company. But unlike mutual funds, ETF shares can be traded throughout the day on stock exchanges, like individual stocks, and the price may be higher or lower than the net asset value because of supply and demand. ETFs typically have lower expense ratio than mutual funds, but you must pay a brokerage commission whenever you buy or sell ETF. So your overall cost could be higher, especially if you trade frequently. The return on principal value of mutual funds and ETFs fluctuate with changes in market conditions. Shares, when sold, may be worth more or less than their original cost. So before investing, carefully consider the fund's investment objectives, risks, and fees, and expenses, which can be found in the prospectus. Read it carefully before investing. Dividends. Dividends are the distribution of a company earning to shareholders, generally paid in cash or additional shares of the company stock on a quarterly basis. The dividend amount per share is decided by the company's board of directors. Dividends must be reported as income by shareholders in the year received. Frequently, investors view dividend payment as an indicator of the company's financial strength and future prospects. Investing in dividends is a long-term commitment. In exchange for less volatility and more stable returns, investors should be prepared for periods when dividend payers drag down, not boost, an equity portfolio. The amount of company dividend can fluctuate with earnings, which are influenced by economic, market, and political events. Dividends are typically not guaranteed and could be changed or eliminated. Yield. Generally, the yield is the amount of current income provided by an investment. For stocks, the yield is calculated by dividing the total of the annual dividend by the current price. For bonds, the yield is calculated by dividing the annual interest by the current price. The yield is distinguished from the return, which includes price appreciation or depreciation. Investments seek to achieve higher yields also involve a higher degree of risk. Index. An index is a statistical composite used to track changes in economic conditions such as inflation or financial markets over time. Investors use some indices as benchmarks against which the performance of certain investments can be measured. For example, the S&P 500 index is considered to be representative of the US stock market in general, but there are hundreds of other indices based on a wide variety of asset classes, market segments, and styles. Keep in mind, the performance of an unmanaged index is not indicative of the performance of any specific investment. Also, keep in mind individuals cannot invest directly in an index. And also, never forget that past performance is not guarantee of future results, and actual results in any investment will vary. Bear and bull market. A bear market is generally defined as a period in which prices of securities are falling, resulting in downturn of 20% or more in several broad market indices over a period of several months or longer. A bull market is a sustained period in which the market rising and investor optimism is high, usually occurring over several months or years. Either of these market trends can influence the attitudes and behavior of investors. To learn more about investing, I have a webinar on investment strategies for volatile and uncertain markets. The webinar link is in the description. You see, your plans for the future shouldn't have to depend on daily fluctuations in the stock market. Gains and losses are part of investing. By using deliberate, time-tested approaches, you may be able to pursue your goals without feeling as though you need to constantly adjust your portfolio to react to today's news. Again, the webinar link is at the bottom. Click on it and we'll see you there.